Welcome to Iron Financial. Here, our mission is pretty simple. We forge stronger portfolios by stress testing corporate foundations and cutting through all the market weakness. And today, the structure we're putting under the microscope is Niu Technologies, the e-scooter company. Now, the market saw their latest earnings report and, it pushed the stock up. But we're here to do the heavy lifting. We're going to separate the load-bearing walls from the cosmetic drywall and figure out once and for all if this company is built on solid bedrock or if it's just rusting away from the inside out. Okay, let's just dive right in, shall we? On the surface, you see some of these positive headlines that absolutely caught the market's attention. I mean, a fourth quarter revenue beat, that always gets the trading algorithms excited. And for the full year, revenue is up a massive 31%. Honestly, that looks like a really solid structural beam. Whoa, hold on a second. Don't get distracted by a fresh coat of paint. Look at the other side of this report, because the bear case is telling a completely different, much darker story. Q4 sales volume didn't just take a little dip, it absolutely cratered, down almost 24%. In international sales, you call that a collapse, I call it a complete demolition. So which one is it? Is the company actually strengthening its core, or is the entire foundation crumbling under its own weight? This is the central contradiction we have to solve today. Exactly. And that's precisely why we're here. The market seems totally confused, sending the stock up on this news, which is just bizarre when you dig in. We're looking at a classic tale of two reports. On one hand, you've got this impressive full-year growth narrative. But on the other, you have a fourth quarter that looks like an absolute unmitigated disaster zone.
And you know what that tells me? It tells me a lot of investors are only reading the headline, not the fine print on the blueprints. So we're going to dig deeper. We're going to pressure test both sides of the story to see where the real structural integrity is.
Now, what's really interesting about this slide is the sheer contrast. It lays the whole problem out in stark black and white. Just look at the full year columns for a second. Revenue up 31%, sales volume up 29%. I mean, that is the story of a high-growth company firing on all cylinders. It's exactly what you want to see as an investor. But then your eyes move over to the left, to the most recent quarter, the one that tells you what's happening right now. And suddenly the whole structure starts to look incredibly unstable. Revenue down over 17%, sales volume down nearly 24%. Look, this isn't some gentle slowdown. It's a full-on reversal. It really begs the question, was all that full-year strength just a mirage? Is this fourth quarter the new reality for NEIU? This is a serious structural crack, and we need to inspect it. This is the kind of language from management that always makes me nervous. I see this quote from the CEO, Dr. Yan Li, and my internal alarm bells just start blaring. Sustained, robust growth in China. Okay, fine, we'll check the blueprints on that in a minute, but the second part, internationally, we are optimizing our retail footprint to maximize efficiency. Really? Is that just corporate jargon for a full-scale, disorganized retreat?
I have to agree. When your international sales volume collapses by nearly 70% in a single quarter, you're not optimizing, you're boarding up the windows. Maximizing efficiency sounds an awful lot like code for shutting down unprofitable operations because your entire global expansion strategy has completely and utterly failed. To me, this sounds less like a strategic pivot and more like desperate damage control.
So let's put that theory to the test. Let's drill down into the plans and inspect the main engine room. Because if there's a bull case to be made for NIU, if there's any solid ground whatsoever to build on, it absolutely has to be in their domestic market in China.
Oh, there's no question about that. Right now, China is doing all, and I mean all, of the heavy lifting for this company. So let's isolate that component and see just how strong it really is. Is it a powerful enough engine to pull the entire dead weight of the international business behind it? That's what we need to find out.
And here it is. This is the number that forms the absolute core of the bull argument. A 41.6% revenue growth in their home market for the full year. Folks, that is not just growth. That is explosive, market-dominating performance.
Yeah, you just can't argue with that number. This is the central pillar holding up the entire structure. While the rest of the company seems to be on fire, this part of the building isn't just standing, it's actually being built even higher. If you're an investor, you simply cannot ignore this figure. It shows undeniable strength and real momentum where it matters most.
So, how are they getting it done? Let's look at the components here. First, the scale is just immense. Over 1.1 million units sold in China alone for the year. They are moving some serious volume. Second, look at that retail footprint. 4,540 franchised stores. They have built an incredible distribution network that basically blankets the entire country. This isn't some niche online brand, it's a physical retail powerhouse.
And the product itself is clearly connecting with customers. That new Windstorm e-motorcycle is a top seller, which tells you their R&D is actually hitting the mark. So this isn't just luck, it's a well-oiled machine of production, distribution, and marketing all working together.
But this is where the design looks seriously flawed to me. Yes, the China engine is incredibly powerful, but is it good engineering to have your entire vehicle powered by a single engine with absolutely no backup? They've built this entire enterprise on one market. The data shows that a staggering 93% of their e-scooter revenue comes from China. That's not a strength, that's a critical vulnerability.
It's a massive single point of failure. I mean, think about it. Any regulatory change from Beijing, any serious economic downturn in China, any little shift in consumer tastes, or even a hot new domestic competitor popping up, and this entire structure doesn't just wobble, it completely collapses. They're not diversified, they are dangerously, dangerously concentrated.
Well, that brings us to the other side of the company's ledger. We've examined the one strong pillar. Now we have to inspect the part of the foundation that is visibly, and I mean visibly, crumbling before our eyes.
Right. This is where the story turns from a potential growth narrative into a serious cautionary tale. The international segment is where the real damage is, and it's just impossible to overlook. The part of the business that was supposed to provide that crucial diversification has, for all intents and purposes, failed.
Just look at this number. Let it sink in for a moment. A 68.4% year-over-year decline in international sales volume in the fourth quarter alone. That's not a crack, it's not a slowdown, it is a complete wipeout, a total and utter collapse of that business.
It's staggering. This business segment was supposed to be their future growth engine. Now it is completely stalled and gone into a nosedive. This one number almost invalidates the entire international growth story they've been selling to investors for years. You have to ask, how does a company even begin to recover from a hit like this?
And this chart, well, it puts the scale of the failure into stark perspective. This isn't just some abstract percentage. These are real, physical units that were not sold. Look at the bar for Q4 of 2024, over 44,000 units, a solid, respectable number. Now look at Q4 of 2025. It's under 14,000.
That's a drop of over 30,000 units in a single quarter, year over year. I want to repeat that. This isn't a crack in the wall. The wall has been completely demolished. Whatever strategy they had for markets in Europe and North America, it has catastrophically failed in the most recent and most relevant period.
And the damage isn't just in the number of scooters they're moving, it's hitting the top line, and it's hitting it hard. For the full year, international revenue was down almost 33%. But the crucial data point here, the thing you really need to focus on, is the trend.
Exactly. It's getting worse, and it's getting worse fast. The decline accelerated in the fourth quarter to over 58%. This tells us the problem is escalating. Whatever headwinds they are facing, competition, weak demand, a flawed strategy, they are intensifying, not receding. The bleeding is actually getting faster.
All right, so we have a pretty clear picture now. One part of the business is a roaring success, and the other part is a catastrophic failure. So, the critical question for any engineer, or any investor for that matter, is whether the structure can actually handle that kind of stress. So it's time to run the numbers. Let's conduct a full financial stress test on the company's foundation and see if it can withstand the immense pressure from its failing international wing, or if the whole thing is about to buckle under the strain. The profitability checkup, well, it shows the exact same contradictory story. For the full year, the picture is actually improving. Look at the gross margin, up to 19.6% from 15.3% the year before. This shows their core China business is becoming more efficient and more profitable. The full-year net loss also narrowed significantly. That's the bull case right there, a stronger, leaner core.
But then you look at Q4 and it's a financial house of horrors. Gross margin shrinks, and the net loss widens dramatically to over 88 million RMB. The net loss margin just exploded to 13%. They are burning cash at an absolutely alarming rate in the most recent quarter. All those efficiency gains from the full year just completely vanished when it mattered most.
Now, the one piece of solid ground here is their balance sheet. They do have a cash pile of 1.1 billion RMB, and that's their safety net. This is the capital they can use to weather the storm, to fund their operations while they try to either fix the international business or maybe double down even harder on China.
Right. With this much cash, they have some breathing room. They have the resources to absorb those ugly Q4 losses and fund a turnaround plan. If you're a bull, you point to this number and you say, see, they aren't going bankrupt tomorrow.
But cash is just one metric. It just tells you how much fuel is left in the tank, not whether the engine itself is fundamentally sound. And this is the number that should make any investor just stop and take a long pause. The Altman Z-score. It's a widely used formula for predicting corporate bankruptcy.
And anything below 1.8 is considered the distress zone. NIU's score is 1.53. This isn't our opinion, folks. This is a financial model that is screaming that the company's structure is fundamentally unsound. It suggests that despite that cash pile we just saw, the combination of low profitability, leverage, and other factors puts them at a very real risk of failure within the next 2 years. The foundation itself is being rated as unsafe.
So, with this shaky foundation and one entire wing of the company in complete ruins, what is management's plan? What's the blueprint for the big rebuild in 2026? Well, they've put out some incredibly aggressive forward guidance.
And the question we have to ask ourselves is this a credible plan from a confident management team, or is it an unrealistic fantasy designed to distract everyone from the current problems? Let's take a look at the specs.
Here's the plan laid out, plain and simple. For the first quarter of 2026, they are guiding for 30 to 50% revenue growth. Now, remember, they're coming off of fourth quarter with a 17% decline. So that is a massive, almost unbelievable reversal they're projecting.
And then for the full year, they expect sales volume to grow by 40 to 60%. That means selling somewhere between 1.7 and 1.9 million units. I mean, these are not modest conservative targets. This is an extremely ambitious blueprint for absolutely explosive growth.
And this is the question that just doesn't compute for me. How? I mean, seriously, where is this growth supposed to come from? They just told us their international business has essentially evaporated. So is all of this growth, this 40 to 60% increase, supposed to magically come from a Chinese market that itself saw a sales decline in Q4? It doesn't add up.
And how can they project this with a straight face when their own financial structure is flashing these big red warning lights for bankruptcy risk? This guidance feels completely disconnected from the reality we just saw in their fourth quarter results. It really feels like they're drawing up blueprints for a skyscraper on a foundation that's just been condemned by an inspector.
Okay, it's time. We've inspected this structure from every conceivable angle. We've pressure tested the beams, we've checked the foundation, and we've reviewed the blueprints for what they want to build in the future. We've weighed all the evidence.
It's time to step back, look at the whole picture, and deliver the final, no-nonsense, iron financial verdict. Is this thing an opportunity, or is it just a trap waiting to spring?
So let's lay it all out, side by side. The bull case is clear. It really rests on a few key points: that undeniable, dominant growth in the China market, the strong cash reserves that provide a buffer against failure, and of course, management's incredibly ambitious guidance for 2026, which, if they somehow hit it, would make the stock look incredibly cheap today.
But the bear case is just as powerful, and I'd argue it's much more grounded in recent reality. You have the total collapse of the international market, you have the deepening, cash-burning net loss in the fourth quarter, you have that flashing red light of the distress zone Altman Z-score, and you have guidance that feels completely and totally untethered from their most recent performance.
So here is our final verdict. This is a high-risk rebuild on a fractured foundation. The bull case isn't entirely a fantasy. That powerful China engine, it provides a legitimate chance for this company to succeed. It is a powerful tool they can use to fund this rebuild.
But you cannot ignore the fractures. The international collapse is a massive hole in their entire strategy. The weak financial health score suggests the entire structure is unstable. This is not a solid buy-and-hold investment. It's a speculative bet on a turnaround. It's a bet that management's ambitious blueprint is somehow achievable, even when the very ground beneath them is shaking.
So to put it in our terms, this is not a structure built of iron. It's a high-wire act with a very, very thin safety net. The cash reserve is that net, but the Altman Z-score and the international collapse, well, they tell you just how high up they're walking and how windy it is up there.
The potential reward is high if they make it to the other side, no doubt, but the risk of a catastrophic fall is very, very real.
And that leaves us with the final crucial question that you, as an investor, must answer for yourself. With their international strategy completely in ruins and the financial foundation showing clear signs of distress, can NIU's China-only engine truly generate enough power to carry the entire company to its incredibly ambitious 2026 targets? That right there is the billion-dollar question. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.